Is it visible?
Yes, sir.
Yes, sir. Okay. Yeah. Any doubt so far?
Yes, sir. Just I was having one doubt. Like you are saying, if you will see the index and the stock relations, so basically, scaling factor is 2. So if you will come to the REIT and BROM, so in that case, if REIT case 0.14 scaling means if index will go up to 1%, in that case it will be 0.14.
Yeah.
Is it so far?
Correct. Correct. So which means
So
it is almost zero. It is near zero in the sense that it is not that positive. It is.
Then, sir, why
Positive
you have right, like in case of 5, you have right 0. So
no. 5 is beta and 0 is one more beta. It is.
okay, and in case of 1 minus 1, it should be minus 2. Okay, here
This
it is
is
right.
1. This is 1. Fine.
Okay, right now.
Is it clear now?
Yes, yes, sir.
So in a hurry, I must have wrote like that. Okay. Is it clear, everybody? Okay. So next, let us go and see what is there in this. Okay. So explain what is systematic and non-systematic risk. Systematic risk means beta of the stock is beta is actually going to be an systematic risk. Measure of systematic risk is beta. Unsystematic risk is going to be the measure of unsystematic risk is your standard deviation. Okay, why we call it a systematic risk means systematic risk affect all the sectors, all the companies whole and soul as per the beta of the stock. Okay, but unsystematic risk is not like that. So because if you are holding Asian Paints, the standard deviation of Asian Paints is something different, right? And if you choose to hold Berger Paints, the standard deviation of Berger Paints is something else. It is. Okay, so based on which what is going to be happening is it is a measure of unsystematic risk. That is your standard deviation, and systematic risk measure is going to be the beta. It is. So the beta will be there, which is there for all these stocks. At the same time, it affects broader market perspective. Whether if the market is going to go up or it is going to go down, it is going to be affecting all these stocks similarly. Okay, so that is what it is in short. Okay, so I can send you a document to read what is systematic and unsystematic risk in detail. You can go through it. Otherwise, we'll be wasting more of our time here only. Let us move towards the next one. What is the expected return of each stock in relation to beta? Okay, so we have not computed the expected return. There is a model called as a capital asset pricing model. Okay, so we are not going to discuss how to derive this regression equation of the CAPM model because we don't have so much time. Normally, we do it in investment analysis and portfolio management session. It is. So how to compute the expected return of the security I is equal to the expected return of security I is equal to the risk-free rate plus beta times equity risk premium. Okay, so what is equity risk premium? ERP stands for equity risk premium. What is this equity risk premium? Is the return of the market minus RFR. What is RFR? RFR stands for risk-free rate. This is the regression line. It is. Okay, supposing if you want to compute the return of let's say REIT, that is expected return of REIT. Okay, how to compute that is RFR, go by this particular equation. So what is the risk-free rate right now? Can you just browse and tell me what is the risk-free rate? So normally we go for a 10-year government
7% around
bond rate, and this is US bond. We should be taking a 10-year government bond rate of US. So tell me how much is the 10-year government bond? It is 4.5% approximately. I am taking that plus beta of the REIT just now we have computed. Okay. So multiplied by the return of the market, how much? Can you just go and see a 100-year return of S&P 500? Just go and write in the Google 100-year return of S&P 500. How much is that? Let us go for 10.5%. Minus RFR is 4.5%. So if you do it, sorry, you get to have a return of the stock.
So what is G24?
G24, right? This is beta of the RE80.
Okay.
Is it clear now? Can you compute what is the, okay, I'll just formalize this. The 10-year government bond is 4.5%. 4.5%. How we got this? Internet search. For US market. For US market. Okay. So how much is the market return? So market return is your S&P's 100 years return. You can ask me, sir, what if index, in case of Indian scenario, we don't have 100 years data, right? So since from the inception, you can take 11.5 to 12% CAGR, you can take. Is it fine for Indian stocks? And the market return is 10.5%. This is the, yeah, so I have written S&P 500, it is S&P 500, 100 years CAG. Fine. So similarly, can you compute what is the expected return of Brown?
11.5%.
Okay, so 4.5% plus beta multiplied by 10.5 minus 4.5. So I got some answer here. Hope it is matching with your answer. Your computed answer. Okay, it is matching. Yes, you have to put yes. So Priya madam, Soham, it is matching with your case. Good. Others, I'll wait for your answers. Put it in the chat box just in case if you have computed. Yes, my answer. Okay. Sharath sir, yes, fine. Varun, Subha, fine. So now we have understood how to compute the expected return. Why we call it as expected return? We can expect that this much is the return you can actually expect from this particular stocks in the next year. That is what it is actually. We have actually computed. Understood now how to compute the expected return of the security? Okay, so can you now compute portfolio 1 return and portfolio 2's return now? Because these are these returns of the individual securities, right? Okay, you know that in the portfolio 1 you have got index and RE80. Similarly, you got in portfolio 2 index and Brown. So how to compute the return? So we should have weights actually. Weights and expected returns of security I. I means some random security. There is a reason we call it as security I. In our case, it is index and RE80, right? So how much is the weight of index? You know, it is 99%. It is 1%. The expected return of security I, that is index is 10.5%. 10.5% in index. 100 years return we have taken up. Okay. See, we are actually taking 100 years return here. Okay, but the wise thing to do is we have to take the yearly return here. How to take up the yearly return? I have told you how to do it. Okay, so that is you have got
Okay.
Then you got index written here, right? Okay. So how to compute this? That is, you can insert one, and I'll show you one just in case if you have forgotten. We added +1, and then what we did is equal to geomin close the brackets -1. In the last class we have discussed this. Okay, so this is the return, and how to compute the yearly return? This multiplied by 12. You know that. Understood this? What we have done? How many of you understood? Just put it in the chat box as yes. Let us see.
No, sir. Can you repeat?
Sir, repeating is difficult because it has already been covered in the last class. Okay, so what we did is this is just the return, CAGR return. How to compute the CAGR return? Okay, so there are few people are saying that they have understood. If you have not understood, anyways, this has been recorded, and the previous videos are also with you. Can go out and see what is it, how to compute the CAGR return of the index. Okay, so I think you know this, how to do it. If you have understood in the last class, that is how we should be computing it. So I'm not spending more of my time. I just take up this 12.02 directly. I copy this and I paste it here. Control-Alt-V, values. Okay, so I have copied this from there. Okay, next is what is the expected return of RE80? Expected return of RE80 is just now we have computed 5.38. Okay, so how to compute portfolio return? Portfolio return is equal to weight of the security 1 plus return of the security 1 plus weight of the security 2. Sorry, it should be multiplied by it. Multiplied by return of the security 2 plus weight of the security n multiplied by return of the security n. So can you now compute the return of the portfolio?
Just by some product.
Sum product. Very good. So sum product is this, comma, this. Hope it is clear, everybody, how to compute. So can you compute now with respect to portfolio, this one?
Yes.
Same, again, weights you have to take. And the return we should know. So for index, I'll be just taking as it is. And for brown, it is equal to how much? Again, it is 1%, right? 1%. So expected return of the index is same as this. So how much is the expected return of brown? It is 11.48, right? So expected return of the portfolio, expected return of the portfolio should be written like this. ERP, expected return of the portfolio, is equal to sum product and you have to mention that in the percentage terms. Okay. So now you have got the standard deviation of the portfolio also you have got. And here you got the standard. This is the expected return of the portfolio, right? And then standard deviation of the portfolio. How much is the standard deviation of this portfolio? That is index and RE80.
0.0287%.
This one, no? And this one is, we already computed, we are just taking the points from there, that's it. Where is it? So I just highlight both of them with bold. Okay, so this is the expected return of the security and this is the standard deviation. That is the risk of the portfolio. This is the risk of the portfolio and this is the return of the portfolio. Okay, so as and when the risk is increasing, the return is also increasing. That is what we can actually see. As and when the risk is reducing, even the return is also reducing. So this is what is evident from this particular example. Is it fine, everybody? This is all I have to say with respect to this particular case. If you permit me, we can go to the next class.
Yes,
Can you
please.
please repeat the last sentence what you told?
No, return is, if the risk is more, return is more. Risk is less, return is less. Okay, so now I'll be stop sharing this. Yeah, so we are back in this particular page again. So can you just download this Session7 template for class DCF valuation short version?
Yes, sir.
It is just an Excel sheet template it is. If you download it, just put it in the chat box, yes. What is the strength of our class actually? 66, no?
66, 67.
67.
57.
7, okay. So all are present today, yes. I am there and somebody from IIM Rohtak must be there. Okay, so what we do now is, let me open that. Is this Excel is visible?
Yes. So hope you must have watched the video regarding DCF valuation or valuation of stocks. Okay, there are various ways of computing the stocks value. There are various models. The first one is the dividend discount model. That is applicable only for the companies which pay dividends, FT dividends. Normally, these companies are actually mature companies, and whatever they are actually earning, they are paying out as dividends. For them, dividend discount model will be working well. And the second one is what? Relative valuation. Relative valuation is something which is applicable for every other company, whether it is declaring dividend, not declaring dividend. For everything, the relative valuation is actually applicable, and it is actually a very simple method of computing the valuation of any company for that matter. Okay, so the third approach is DCF approach to enterprise valuation. So the DCF approach is more time consuming, at the same time more tedious to compute it. Okay, so I don't know whether I'll be able to do justice to this DCF approach, because we have actually we have just kept only one class, one session for the computation of DCF valuation of stocks, in other words. Okay. So this is very complicated when compared to the valuation of the bonds. Valuation of bonds, if you know how to compute the price is equal to price, and you just compute the value of the bond very easily, just in one cell, one step you can compute. But in case of DCF, valuation, you require data like the profit and loss account, you require balance sheet, you require cash flow statement, many other information is required for computation of DCF valuation. Since it is most robust thing, I thought of choosing this for you for your session. Let's see how effectively I am actually going to be doing this. It is going to be a challenge which is there in front of me today. Okay, so let's see what is this DCF valuation is all about. So firm's free cash flow is supposed to be computed, and what we do is the firm's future cash flows we discount back to the present value terms at an cost of capital, that is WACC. So that is what is the value is, which is actually called as the stock's value. That is intrinsic value of the stock we are actually going to be deriving. Okay, the firm's weighted average cost of capital is very important. That is what is the risk adjusted discount rate. We normally call it as a risk adjusted discount rate, and that is the rate at which we'll be discounting. The firm's enterprise value is the present value of future cash flows. Okay, so supposing that if I have a company, the company will be having cash flows, right? How company is going to generate the cash flows? By profits, by revenue. Revenue is going to be getting converted into profits. Profits will be normally the inputs for the cash flows for us. And every other profits we cannot call it as a cash flow, and we have to adjust and we to some of the variables, and we call it as an free cash flows. Why we call it as free cash flow, we'll tell you in a moment. I'll tell you in a moment what is it. So all your future cash flows will be discounted at an appropriate discount rate, which is called as a WACC. Okay, so T is equal to 1 to infinity. What is T? T is your year 1, year 2, year 3, year 4 till infinite number of years. All the cash flows of your company. Supposing your company is TCS, all the future cash flows for infinite number of years, I should be knowing it. Then I'll be discounting them back to the present value terms. Okay, at the appropriate cost of capital. Cost of capital is weighted average cost of capital, or WACC, can be used interchangeably. We have not discussed how to compute WACC still. We'll be discussing in the next session actually. Okay, so how to compute? Let us discuss in the next session. Assuming that 12% is the WACC hurdle rate for the let's say TCS. So if I compute this, then I should have computed the enterprise value. Okay, this enterprise value plus cash minus debt, number of equity shares outstanding. If I do it, I get equity value per share. Equity value per share is actually called as what? Your intrinsic value. And you compare that intrinsic value with the market price, and you take a decision that whether to buy or whether to sell that particular company's share. Okay, this is that detail it is. Okay, so this leads to what is FCF divided by 1 plus WACC. This we already discussed, plus terminal value. Okay, so terminal value is 1 plus WACC. We'll say what is terminal value when we compute this. It is going to be very difficult to explain it in one go. Okay, so if you just follow this particular equation, you should be able to compute the enterprise value of the firm. Okay, what is this free cash flows to firm? Let us discuss now. You know what is EBIT, right? You must have understood this in accounting course. It is earnings before interest and taxes multiplied by 1 minus tax rate. Means we are effectively deducting the tax from EBIT, which means EBIT, it is EBI only. It is not T is not there, EBI it is. Earnings before interest. We are not, we are actually deducting taxes, and that is actually called as what? NOPAT, net operating profit after taxes. Earnings before interest is also called as net operating profit after taxes, but before interest. Okay, then we add depreciation and amortization, because these are the non-cash items which are there in the company. So we can actually use it for investment activity, and that is the reason we add that. And any capital expenditure, if you have actually done it, then we are going to deduct that. In any year, if you have done any capex, we are going to deduct that, and we are going to add, or we are going to deduct a change in the working capital, as a case may be.
But
Okay,
so this capex is converted to amortization, isn't it?
No, capex is actually what? Capital expenditure, like you buy furniture, land, building, all that.
I know that, but normally capex is like plant expansions or any extra battery has been added into the production.
Any
so that
capex
is
production. Any
completely, that
capex.
is not completely reduced from the books, but it is amortized.
Amortization here, it is not amortization what you are thinking. It is the depreciation on the intangible asset is called as amortization. It is.
So that is right. The depreciation on the asset you are saying. So, but the capital expenditure which you have spent, you like for example, 100 crores you have spent for an expansion of your plant. Capital expenditure has been done. So straight away you are going to subtract it from the year's profit. That might
What I
not
do
be
is
there.
I'll actually call it as net debt. It is net capex. It is. I think I have made a mistake in writing it. Net capex means it is net of depreciation and amortization.
Okay.
Is it
And
fine?
please also correct, sir, EBIT. Please make it EBO.
Pardon?
Yeah,
Okay,
it
that
should
is
be
only one
EBA.
man's taxes.
EBIT is correct, no?
That is correct. One man's tax is no bad. It's okay. That is okay.
Yeah. So it is net capex. It is. So I think I made a mistake in not writing net there. That is the reason you have there is a confusion which has come up there. So the resultant figure is actually called as FCF, and this particular FCF which happens year after year, I have to discount it back to the present value terms with an appropriate discount rate, which is your WACC in this case. Is it clear? So now, this is all you can actually go through it. Okay, so this is all I have to say with respect to the thing. So hope this is visible, everybody. Excel.
Yes.
Yes,
So, so what we do is this is the shorter version of this. Normally, DCF technique, if you want to explain for, I teach financial modeling for my regular PGP students. So I take almost 6 to 7 hours of discussion for modeling a company through DCF. Okay, but this is a shorter version of that to make you understand in an effect what is DCF valuation. Okay, if you could get understanding of what is DC, if you get a hang of what is DCF valuation through this short example, I hope if you go for some other financial modeling courses which are available on internet or maybe elsewhere, you should be able to understand what is DCF valuation, the crux of it. Is it fine? Because it's a shorter version. In what I can do it in one session, I am doing it here. Normally, what happens is any finance professor, they normally tend to go for a dividend discount model, and they teach you just in 30 minutes or maybe 45 minutes, and they'll clear your doubts in the next 15 minutes. And that's how the professor also saves his time as well. So since I want to do this, I want to make you to understand this. Since you're all company executives, I thought I should give you a comprehensive example. Though it is not comprehensive example, what I can do it, what it can be done in one session, I am doing it. In other words, is it fine, everybody, class? Okay. So income statement, it is here. I have taken from 2019 till 2024. It is okay. So balance sheet, it is there for the last 5 years. I think 6 years data is there here, right? 6 years data is correct. So 6
Yes.
years data we have got it, and the model it is. So everybody has got the same Excel sheet. So whatever I do it, the cell references will also be same. That is the reason I thought of going for this particular template. Otherwise, you'll be having a number of confusion like what is that cell reference, and because getting cell reference is going to be very difficult if you have got different Excel sheet with you and me. Is it fine? Shall we start the process now? So first, what is our first step is we have to actually compute the FCF. How to compute the FCF? I actually put up here already. You can see here. What all I explained here. Okay, so this what is that I explained here. It is essentially we are actually computing FCF through this particular modeling. Is it fine? Now let us go. What is our first line item? It is our first line item is revenue.
revenue.
Everything is in million rupees. It is okay. So you have to just do the way I'm doing it. Okay, so it is more of an physical exercise. It is for your hands. And also at the same time, you should be understanding what I am doing in the background as well. Fine. Is equal to, tell me where the revenues are there. Revenues are there in the income statement.
Income statement.
I go exactly there. I pick up where the revenues are.
D7.
Okay, so I just enter here. And again, I copy this. You have to do, we should be very fast in doing this. So we have actually taken up all the figures for revenue. Is it fine? Others who are unable to do match up to my speed can just observe what I am doing, and later on you can come back and do this. Is it fine?
Yes.
So we compute the revenue growth here. What is revenue growth? How to compute the revenue growth? It is percentage terms. It is this year's minus
last year.
previous years divided by previous year. You know it how to do it, right? So this divided by this. Okay, so if I just drag it to my right, I should have computed the revenue growth. Correct? Okay, so can we now go to the operating? We'll forecast later actually. What is total operating expenses? Where will be there it is?
Income statement C11.
Okay, so operating expenses, this one. C11. Fine. So I'm just copying this and pasting it here. So expenses growth, it is easy. I just copy this line and paste it here. Done. Automatically, this Excel will take care of the above line only, right? What is EBIT? You know, EBIT is equal to revenue growth. Sorry, revenue minus
Tax.
your OPEX. Correct?
Total operating expense. Does it include taxes? Operating expenses.
Now, tax will come here. We will compute the tax rate as well. EBIT is what earnings before interest taxes, right? So it is also
Right.
the taxes also there actually. Okay.
Okay.
So we want to compute the tax rate for our purpose because you can see FCF is equal to EBIT multiplied by 1 minus tax rate. Can you see this?
Yes.
That is the reason we compute now the tax rate. So how to compute the tax rate? It is pre-tax, the tax paid divided by pre-tax income. Correct? So let me go here, income statement. Let me search where is the taxes.
Pre-tax. 26.
26. Okay. So pre-tax is here. Okay. So taxes are how much? I want to compute the tax rate. So taxes divided by pre-tax.
That's income. Next step.
This one. This is income tax divided by this 15,181. Pre-tax income as per GAAP and as per adjusted, both are there. Let us not confuse. Okay, so we can actually go by whatever it is there GAAP. If you're going by GAAP, let us go by GAAP for all. That's it. Okay, it is not going to cause much of a difference. Fine.
So how it converted into percentage? Yes.
Percentage, you have to do percentage. That's it. Shall I show you once again?
Okay, this divided by that gap.
That, yes. So this is equal to income tax expense. This one, that is 34 divided by 33. Fine. 34 divided by 33. Enter. And I copy this and paste for the rest of the cells.
Okay, this EBITDA divided by tax rate.
So we want to find out the tax rate. How to find out 34? This is the tax expenses divided by pre-tax income. If you do it, you get the tax rate.
Okay.
Only just the tax rate. That's it. Nothing else we are worried. There are many information here. We are not worried about all the information. We go by this particular model. That's it. We want to extract the data from this particular incomes, all the financial statements. We just put it here. What is that we require? Is it fine?
Yes.
Next is depreciation and amortization. So we go, where are the depreciation and amortization? It is there in the income statement, right?
Yes.
Income statement, right? To go for depreciation, where is it? Can you see your 14 line item? So line item 14 it is. So I copy this, paste it to my rest of the cells. Is it clear, everybody?
Yes, sir.
Now I want a
Net
net capital expenditure. You know that it is capital in nature. It will not be available in the income statement.
balance sheet.
It is available in the balance sheet and the cash flow statement. Easier way is going by the cash flow statement. Okay, go to cash flow statement and search. Okay, where is capital expenditure? You can see this change in the fixed and intangible assets. Cash flow from investment activities, there is a minus figure. It is. Why there is a minus figure? The cash is going out, moving out of your business. So that is, it is minus figure. It is. So 4,229.3 million rupees is what it is. Change in the fixed assets and intangible assets, which means what is this is actually what the capex happened for the year. Minus depreciation and amortization. If you do it, you get net capex. Is it clear? This is your capex. Okay, and if you have depreciation and amortization, which is known to you, okay, so if you
Minus.
deduct the figure, what you get is the resultant figure will be what? The resultant figure will be net capex. Hope is it clear?
So it will be negative.
No, we have to convert this into positive. I'll write it. Just concentrate. It is C22. Cells reference is C22. I go to model now. Is equal to, just see here. Is equal to, go to cash flow statement. This what?
Minus C8.
Minus
C8 in the cash flow depreciation is given.
here only we have done taken up already, right? Is it clear?
Yes, a P13.
We have already taken up, so let us not worry where is it. So multiplied by, I'll do minus. Is it fine? Hope we have taken that, or are we doing wrong?
Sir, we have to, I think the CF, the C22 cell itself, we should put a minus sign.
Yes.
So that it becomes a positive money amount. Put a minus, yes. And then you subtract the depreciation amount.
Is it fine?
Yeah.
I think this is now it is correct. Looking good. Looking correct.
So CF into
You can just copy whatever I did it. So automatically it comes up there because all cell references are same. Just in case if you have missed it. Shall I explain this once again?
Yes, sir.
Yes, sir. Yes, sir.
Same value is not coming.
Fine. I am there at the square, back to square now, is equal to. So CF, this is the cell reference, right? Multiplied by -1, I am doing it because I want to convert this minus into positive number. That's it. Is it clear?
Yes.
And then what I want to do is minus the above line, depreciation and amortization. Is it clear?
Yes.
I press enter. Since it's an Excel sheet, it automatically takes into consideration of to do Control C, Control V, automatically it takes care of it. Is it clear? Everybody with me?
yes.
Okay. So let us go change in the working capital. So change in the working capital, where is it? Let us search. Can you see 13 change in the non-cash working capital? 13, CF 13. So we enter that now. So Control C and Control V. Done. So if you have done until this, can you just put it in the chat box as yes? until this.
Just a minute.
So can you just go to B15 once? I just wanted to.
P15. Okay.
Sir, one question, sir.
Huh.
Change in working capital is shown as positive in cash flow. That means money has come in. So in this, working shouldn't it be minus?
No, whether it is minus or plus. What is your question? Come again.
So my question is, in the cash flow, it is showing as positive. That means
Okay.
money has come into the business.
Okay.
And in this Excel sheet that we are doing, everything is in positive and negative only when money has come. So in this remain as it is, or will it be minus? We have to change the sign.
You can see here minus increase in the working capital is there.
Yes.
Right.
We'll add it then. Yes.
Just a minute. Now let us keep this as it is, minus plus plus. Okay. The total effect is coming up here. You can see total of all this.
So one thing in CF, what do you in CF tab there? Can you please? No, there was one formula written or something you had mentioned beyond these tables. Yeah, capex minus.
Yeah, it is recorded, madam. You can go through it, because I think this is very simple. We have discussed thrice actually this one.
Okay, fine.
Capex minus depreciation is net capex. That's it.
Okay, you have just mentioned it, not calculated anywhere.
No. We have computed here in the model. That's it.
Okay. Sir, we don't get the recordings actually.
Is it?
Yes, we don't get it.
Oh, this is surprising. I didn't knew this.
And even though today I had requested for the recording, but still not get response
Even
from
it is
the
not recorded in my device
office.
as well.
No, actually we can record, we can do a screen recording, but for that it is asking for the permission.
Oh, I didn't knew this. I thought recording, since it is recorded, I thought it is given to you. That is the reason you're asking so many times, like if you're not understood.
Yes, sir.
Got it. Because I was in the impression, why is this so many times repetition is happening? Okay, got it. Okay, so shall we now go ahead?
Yes, sir.
Yes, please.
What is our goal here? Our goal is we have to compute the FCF for the next 5 years. Okay, so that this value should come up here. This is our historical data. Okay, so we want to convert with this particular historical data. We want to compute what the forecasted figures, same figures, forecasted figures, so that we can compute the FCF for the next 5 years. Fine, that is what is our target. That is the reason we have done all these things. So can we now forecast now? Let us see, can we forecast? Because this is the most, it is difficult to convince the participants or students, whomsoever I teach, because forecast is a forecast at the end of the day. Okay, so at the end of the day, you have to understand that the value, okay, you tell me what is intrinsic value of the company. We are going to arrive at here, somewhere here. Okay, so intrinsic value per share will be computing for this, what is this company called as? I think I have not mentioned the name of the company also, right? So this is the data which I have downloaded from the Bloomberg. So I asked for Rohtak, I am Rohtak, that do you have Bloomberg terminals, so that I can actually show how to actually fetch the data from the Bloomberg, so that I can teach this how to fetch the data, and I will ask the participants to work on this. But they said they don't have Bloomberg and they got something else. So that is also on the way. It is not been materialized. So this particular access, we have got Bloomberg access in MDI Murshidabad. So I have actually downloaded this and I have converted this as a template and I'm giving it to you ready for. But when you do this, you should have some access to any of the annual reports of the companies. Okay, so you can actually download it freely from Money Control or any other website which are available, and still you can actually do this. Is it fine?
I have not shown you how to download because if you
But
just
it is there on investing.com and all those things, right?
So anyways, you can do
Yes.
it. But, this has been downloaded from me by the from Bloomberg. Okay, so this is only for your information. It is. Now you tell me, who will be knowing the intrinsic value of the stock precisely? This question I should have asked you at the start of this session. I think somehow I forgot. So tell me, who will be knowing the value of the company? In other words, the value of your value of the company. Who will be knowing?
The board of directors of the company.
Okay, so you can just put it, write it in your chat box quickly, whatever. We don't want to waste our time. Just go put it in the chat box. I'll read it for you. As per you, who will be knowing the value of the stock or the valuation of the stock? Okay, Asif sir is saying owners and shareholders. Vaibhav is saying the stakeholders. Sachin is saying charter content. Naresh is saying shareholders. Any other answers? Auditors, owners. Okay, so Mayank is saying no one. CFO, Vikram is saying the CFO. But there is one who knows the value of this particular company. Shall I tell you the answer? The answer is only God knows. Okay, the true value of your company. Okay, that is the reason I said, because to confuse you. In other words, I want to also confuse you. That is the reason I asked you this question. Okay, nobody would be knowing precisely what is the value of your company. Okay, but however, everybody knows approximate value of your company. The company, for example, the Britannia Industries. We may through this particular valuation exercise, you have to understand that we can only value approximately the value of the company. It is impossible to value precisely the value of any company by any human being. Because so much of judgment goes into computation of this, so much of assumptions which go into computing this. What should be our goal is, our goal should be to come up with a value for the company which is approximate value of the company. We are okay with that. We may not be able to come out with the true value or the precise value. However, we can actually come up with the approximate value of the company for our companies. Okay, so that is all we are trying to do it. That is what I wanted to remind you before we actually start this exercise. Because so far what we have taken is only historical data. Now we will be doing now, based on the historical data, we want to now do some sort of forecasting. So forecasting, you know that it may go wrong or it may turns out to be true as well. So it is not in our hands. So because can we predict, supposing if I'm setting this in 2019 and if I'm doing this analysis, do I know 2020, 2021, the COVID will be get hit and the pandemic is going to hit, and because of which my company's operations will be disrupted? Can I forecast that beforehand? I can't really do that. Is it not? So that is the reason it is all actually going to be a sort of uncertainty goes into it, and that is the reason we call it as forecast. So let us see. Okay, so now we have to compute this for 2025. How to compute for 2025? Can you tell me, can you guess? What you have got the sales figure for the last 5 years. You have to forecast for the 2025. How do you do it? What is your mind is saying for you?
Average of 11.64, 4.29, and 12.57, like average of all this.
Okay, so this is the what I do is, since I also felt the same, it is so average I'll take up. Okay, so 10.27. So I'll tell you how to actually do this, how the
So there is a forecast function in Excel itself.
No, I'll come to that, because forecast function will not work every time. Okay, that may not be the right way of doing it, and we'll come to that as well. So for me, how to do it, I'll tell you how to do for revenue growth is, you have to attend the company's con call. I am telling you how the equity research analyst will do this. Okay, he will attend a con call and he says that what is the growth you're expecting for the next, what is the sales revenue you're expecting? Are you going for any expansion activities? Because if I go for expansion activities, what happens is my revenues will also be more. And to take that particular revenues to take place, maybe for the first 2 years or 3 years, I may not be having any sort of growth, which may not be there, because I just want to break even, maybe for the first 3 years or 4 years. Okay, so that is how I should be taking up the clues from the attending the company's con call. If you attend the con call and you also get the transcription of the con call, you can just go to Google, and if you type, okay, the transcription of the con call. So, by the way, you should also know what is con call, company's con call. How many of you know it? Can you explain if somebody knows it?
It is the shareholders meeting wherein the board of directors give the overview of the company and the path that they're taking. I mean, it is generally the time when they unveil the annual report.
Okay, so I'll tell you, the con call means it's an investment relation officer will be there. There is a conversation which happens between that person and the probable investors of the company, prospective investors of the company, or maybe existing investors, or maybe analysts, whoever they are. They are going to conversate. If they have got any questions with respect to company's growth prospects, anything related to company, if I want to clarify, I can very well clarify that with the company personnel. That is actually called as con call. That has been recorded, and that has been transcribed, and that is posted on the company's website. And you can actually download that report and you can go through it. Okay, that way also it can be done. Okay, so for now, for easiness, since I told you I want to go easy method, so I'm just taking the average of this. Okay, so please, if you have got any other better version of doing this, please go ahead and do it. Okay, I'm not stopping you. It is your creativity. You can, since it's your exercise, you can do it. But to start with, you can see, you can do the way I'm doing it. Later on, you can change it. Is it fine? So since I got the average of this number, or I can also do sometimes I can choose to do this way as well. Since 4.29 is actually going to be very less because it's a COVID year, it's an outlier. I'll actually, I don't want to consider 4.29. So what I do is I'll take an average. I'll take an average of this, this divided by how many numbers? 4.
Bracket.
I can actually do this way as well. I am leaving it to your creativity. Okay. Okay. So whichever the method you are okay with it, you can go ahead with this. I am showing you the ways and means how people are going to forecast. Okay. So how to do this for 2025? 2024 I'll pick up. Okay, multiplied by 1 plus 11.77, close the brackets. Is it clear? And now repeat this for the rest of the years. Now I'll fix it with F4, close the brackets, press enter. Then I copy this, then paste it. Hopefully I must have done my job. Okay, if I change this, automatically my figure will change here. I just want to show you, that's it. Clear?
Sir, can you please click on the forecasted figure? Okay.
Next cell, please.
Pardon?
Next cell, 20363. Can you please click on the next cell, 2026?
Next cell, huh?
Yeah.
Sir, why do we do 1 plus H6?
You add 11.77% to that, that's it. If you multiply 1 plus that,
Yes,
will be
got it.
same as that.
Yes, got it.
Got it? Is it clear until this? Shall we move to the next one? The total
Yes, sir.
operating expenses. You can see expenses growth. You can see how the expenses growth are happening. So I would like to disregard this year because it's a COVID year. This is an outlier. Is it fine? Same I did here as well. Clear?
Hopefully I must have copied the cells properly. You can see. No, I have not seen. I have to just change this to this and fix F4. And now again, do this. Done, everybody? Or I'm going fast. Otherwise, we'll not be able to reach. That is the reason. So Vaibhav is saying that I should say to PGPX office, okay, so that they'll share the video. If I say they'll share,
Yes, sir.
Yes, sir.
but I feel you guys can actually screen record yourself, no? Is it not possible?
Sir, for that it is asking for the permission. Just I have
There's
asked.
No, you have got your own
Yes.
ways and means for doing it. If you just Google it in the YouTube, you should be able to get the answer.
It's possible, sir.
Yeah, somebody said you can just follow that. Somebody
Actually
else
doing it.
Yeah, you can just share with your fellow classmates and also with me if you don't mind.
Sure. Sir.
Okay, so next is what? Next is tax rate. So can you say something about tax rate now? How shall
Yeah,
I
I
do
also
tax rate?
I also got the answer. Window plus G for the screen
Pardon?
recording. Window plus G
What is window G?
for the screen recording.
Okay, okay, got it. Fine. So now, how to do the next item, tax rate?
We
I think
can take the latest one.
the EBAT easily we can do it. This minus this, sorry. Correct? So do it for rest of the cells. Now we want to compute the tax rate. How to do the tax rate? How to actually do this? Any idea?
So we can take the latest one.
Latest one. Anything else?
Sir, which formula you have used to calculate this 2591?
No, I tell you the method. Okay, you can see 33.9 and that is 34.6% for 2020. The corporate tax rate in India was 30% at that point in time. Okay, so from 2021 onwards, what has happened? The corporate taxes in India slashed to 25% by our Fin Minister Nirmala Sitharaman. Hope you remember this. Okay, so let us take average of the somebody mentioned last few years.
So sorry, how you calculated this? I9.
How I computed
Yes.
this one again going back
I9.
will be difficult because I'll share this Excel sheet with you. The moment you click on it, you'll be able to see.
So this one for 2025, 25,819 that values.
This one?
Yeah. Yes.
Yes, this
It's
one.
easy. This is this minus this. That's it.
Okay.
Fine. You got this. This minus this. There is one more method of doing this. A tax. You can only take what is applicable for the last year as well. It is up to you, and you can keep this as constant for rest of the years. If you feel that this is not correct way of doing it, okay, the best method for you is go for first 4 years as I told you, average, and you can fix the cells F4, F4, press enter, and then drag it to your right. Is it fine? As I told you, we are approximately going to compute this. It is not going to affect much. It is not going to affect much whichever the way you are going to do your solution. Fine. Next is what? Depreciation and amortization. See, normally depreciation and amortization is dependent on the capital expenditure. So if you know the capital expenditure, future plans of the company, you will be able to predict that. Otherwise, it is going to be difficult. It is. Okay, one way of doing this is what? You just copy this. Somebody said forecasting, linear forecasting. So I can just go here, next sheet, and I control Alt V, values, and I go to model. I pick up this years as well. So now what I do is I'll copy this and I want to paste it vertically. So I use the transpose function. How many of you understood what I did? Just
Yeah, we know.
forecast this for the next years. So 25. So I take up for the next 5 years until 2029. So I put is equal to. I go for forecasting. So I click linear forecasting. So I click on FX. So what is this X values with the for which date you want to forecast? This is I want to forecast for 2025. So I put it there. What is my y variable? This is my y variable, and this is my x variable. Okay, I click OK. I got my values. Can you do it quickly like this? I'll wait for you guys. So by the way, what is this 1420? All that. So this is this figure it is. I copied this and I moved to the next sheet. That's it. So take some time and do this quickly. So once it is done, you can just put it as yes in the chat box.
Sir, what was X here? X was
2025. You want some more time?
Done, sir.
Done.
So now double click on it. Or you can, if you want it, you can also fix these values also and see what is happening there. This is going to be higher value. So I can actually go back and see, say that I don't want to do that because I want to be slightly conservative. I don't want to go for aggressive. That is the reason I kept it low as possible. Fine.
Yes.
So I'll take the value whichever is less because I want to be conservative in my approach. That's it. Okay. So I can also show you one more for exponential forecasting, trend forecasting. I click enter and you can see what has happened. My values are actually much lesser than this, right? Okay, so I can think of going for taking up these values because these are actually going to be slightly more conservative than these values. It is up to you which one you want to choose it. But if you ask me, we should choose which one which has got more conservative one. Is it clear? 1982
versus 1903. I feel this is more conservative. So that is the reason what I do is I'll copy this. I'll paste it here with values. So I copy again this. I go to model. I go here. Then I paste transpose. Hope you must have understood what I did.
Got it.
Got it?
Yes.
So I want to have the same format as this. So I click on format painter and I do this formatting. Done.
Done.
So net capital expenditure, difficult to forecast. Okay. So I do the same method what I did just now. Is it fine?
Yes.
So I go here, paste it or Control Alt V. Go fast, do it fast. Okay. So I copy this. Or what I do is I'll just copy paste from this sheet. Done. So a higher side, because you can see minus values are also there here. So let me go for this one. Which is more? $846. This is low.
So you have done exponential forecasting here?
No, I am going to go with whichever the one giving me lesser answer. Okay.
Done.
Format painter. Format. Done, class.
Done.
Yeah, how many have you done? Just put it in the chat box. Yes. I'm just curious to know. Want some more time? Shall I wait for 30 seconds?
The last calculation like 420, how you
Last
have
calculation, I went with the linear flow
calculated?
system. Okay.
Now FCF.
Shall we go for FCF now? What is FCF? Can you see this highlighted?
Free cash flow?
Free
Free cash flows to formatters. Let us go quickly do it. So we have got all the ingredients, right? EB80 multiplied by 1 minus what? Tax. Next what? Depreciation and amortization should be added, na?
Okay.
Next is what? Net capex should be deducted. Minus increase in the working capital. So I did that. Fine.
So it is progressive every year.
Progressing, na? Okay, until FCF done.
Yes.
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 Okay, so this can you come to this yellow cell?
Sorry.
Can you come to this yellow cell and put it or your cursor
Yes.
there? Okay, how we have computed? I'm just going to put it as a formula text. So what we have done so far? We have computed the FCF for this is the forecasted FCF for the next 5 years. Forecasted FCF for the next 5 years. But what we want? Tell me. We want FCF for the FCF for from next year onwards till infinite number of years. Correct?
5 years.
No, what we require FCF is FCF we have computed for the next 5 years. But what we really require is we want this FCF for the infinite number of years.
Right. Okay.
Going by this
The limit formula. The sigma.
going by this equation. Okay. So what we have so far computed is T is equal to 1 to 5 FCF we have computed, right?
Yes.
But we have to compute the terminal value. What is terminal value? Terminal value means starting from T6 till infinite number of years, we want the value. All at once we will be computing here in the yellow cell. This is terminal value. Is it fine?
Yeah.
How to compute that terminal value? I'll write it here. This yellow cell. This is equal to FCF in 2029 multiplied by 1 plus long-term growth rate. GROWH growth rate whole divided by WACC minus long-term growth rate. Can you just write down this quickly? Done?
Yes.
So can you, before moving ahead, what we require now? We got FCF 2029.
Yes.
So can you come this side? How much is the WACC for this company? Can you go to Google and just do the Google WACC of Britannia Industries? Tell me how much is it?
11.9%.
It may be varying because you're looking at two different websites maybe. But we will compute in the next session. I'll explain how to compute this. Fine. Class.
Yes, sir.
Long-term growth rate.
So long-term growth rate, what is a proxy for long-term growth rate is your GDP growth rate of the economy of India. Can you find out now quickly? Shall I take another 10 minutes extra? Because let us complete this.
Okay. Yes.
Yes, sir.
Yes.
Hope you guys are curious to know what is the answer, right?
7.2%.
7.2.
1.2.
Is it fine? So now we got all the ingredients. Shall we compute this cell, terminal value cell? If you're done with this, you can just put it in the chat box as yes.
Yes, sir.
What is the answer here?
What is the value you are getting?
And let us see the value. But
690, 415.
Sir, what is this that we have calculated?
610 something.
this is the terminal
61024.
value. What do you mean by terminal value? Means the val FCF. This is the present value of FCF from the start of 6th year till infinity. Fine.
Okay.
This is terminal value. This is also called as PV. Terminal value. Addition, sum of these two.
Sum of
This and blank. This and blank. Only in the 5th year we'll be having this. Done?
yes.
Okay. So these are actually called as what? The present value of FCF it is. So can you compute present value of FCF now? I mean this cell.
Okay.
How to do that?
What? the rate will be
WACC.
long-term growth.
No,
WACC.
WACC. This is the
WACC would be
this is the rate you should be using, because we are going to discount it back to the present value terms at WACC.
Yeah.
Okay.
Okay. Hmm. TMT
is equal to in one step you can compute this with NPV function. Fine.
We have taken this WACC rate, in place of rate. Okay.
So the rate is WACC. Values are these values.
Structures. Present value of
Present value of all these future cash flows. So how much is cash?
Sir, it's above, sir.
This will be in cash flow. Not really cash
Less than
flow.
cash equivalent.
Okay.
We'll go for this.
10,319.
Fine. Debt means both short term and long term. Short term borrowings F48. This is for 48 plus long term.
That was above.
Number?
LT above LT liability. Yes.
58,
LT
na?
Yes, sir.
Done. Can you now compute equity value? Done. How many shares are outstanding?
40.9, sir.
Where is it?
Balance sheet.
It is there.
Yeah, the balance sheet is there, sir. At the end. So yellow, marking yellow.
That in yellow in million. 240.9.
This one, no?
Yes, sir.
86, H86, right? Recent one we should be taking. So how to do intrinsic value now? This divided by number of shares outstanding.
So what is the market price as on 31st March?
Intrinsic value.
As on today, it is 4731.
4731. Assume that this is the market value as on this date. Okay. Right. So our intrinsic value, what we have computed as per us is 1733. And the market value is 4731 approximately.
So from where did we get that?
You can just Google it.
Okay.
What is the recommendation? We're holding it. We should sell it. Otherwise, we should not buy it. As per us, if the market value, if it is for 1733, then we should buy as per this particular valuation. Is it fine? Are you all getting the same answer or different answers?
Same answer.
Mine is different. Actually, I have used different tax values.
Okay. So this is
It's
all about
approximate.
this. This is all about this. Hope you must have understood this. So how many of you understood what we discussed in today's session, especially this one, the intrinsic value of a stock?
Sir, we have understood, but why we were doing this, all this exercise, that conceptual clarity is not that much. But we understood that how to calculate.
So normally it does come with this much of difference, like market value and intrinsic value.
It happens, supposing if there are analysts sitting and doing this exercise, they'll do this and they will actually see this is what is the value of this. They're starting doubting their valuation methodology actually. Okay. And what they do is they will also compute what is the value based on relative valuation. And they'll actually change some of the things here. Supposing that if I change this WAC, let's say, for example, 10%. Okay, so automatically my value will change. Okay, so I say that long-term growth rate, I want to change it to now 6%. Okay, again, it is changed. So I say that it is 9%. Let me see, like 9%. It is. So you can see the intrinsic value became 7,153. Okay. If you slightly change it, it is going to change. Getting it?
Sir, but in today's scenario, you think there will be large cap companies having their intrinsic value same as today's market price?
No. It is very difficult to say that way. Okay, maybe it is overpriced or it may be underpriced. That is the reason we are sitting here to compute the intrinsic value. If it is the same, then everybody would have actually gone out and bought this. So normally it has been done by the analyst, and that is how it has been done. It is actually a very difficult exercise, but we have done so many assumptions, right, for doing this. Supposing we have actually used very short data here. Normally how it has been done is I'll take out the balance sheet. I will forecast the balance sheet for the next 5 years. Believe me, that is how it has been done. I'll forecast the cash flow statement for the next 5 years. I'll forecast the profit and loss account for the next 5 years. And then I pick up the values from those statements, and that's how I come out with the FCF. Not this short method, the way I showed you. So, but overall, you got the sense of how the intrinsic valuation has been done. Okay, so generally it has been done this way only. If you have understood this short version, okay, if you watch any videos with respect to let's say 7-8 hours videos with respect to one particular thing, you'll be able to understand that very easily. Okay, so you have to read a lot actually before coming to the class. You have to read completely and then you have to come to the class. Then only it happens that way, because there is going to be a textbook given to you. You have to go through this and then you have to attend the session. Then you'll understand what is being taught in the class. You'll be able to make some sort of connection there. Otherwise, it is going to be completely difficult for you to understand this. Okay, so supposing that if I would have explained you theory,
that would have taken 35-40 minutes. I can easily done that, and I would have said that intrinsic value calculation, it is not possible to do in one session, so let us not do it. Instead, you read the theory, na? I'll give you the slides, I'll give you the material, go read it, and then redo this exercise, you'll understand. Is it fine?
Yes,
The
sir.
hard thing we already done. Only the softer part of it, you should actually do it. Okay, so in one session of 75 minutes, what best can be done? Trust me, I have done it. Okay, it is up to you how much have you grasped out of it. And many things are there I have not explained. Okay, why have you taken long-term growth rate? Why have you taken WACC? So for that, you have to read the literature, then you'll understand. Okay, so because why have you taken long-term growth rate as economist growth rate? Because it in the long run, it is assumed that the companies cannot grow beyond the economic growth rate. That is the normal assumption which is being done by equity research analysts. Okay, so why WACC we have taken? So that is a weighted average cost of capital, and I never told you like how to compute that. So in the next session we will compute that. Okay, what I'll do is I'll explain you how to do it. WACC and everything else, beta, everything else I have told you. Okay, so then I'll give you a comprehensive project. You will come out with you have got groups, right? I'll be each group will be picking up a different company of your own choice, and you'll be coming out with the valuation for your own company. Is it fine?
Okay,
This is
great.
the project you'll be doing it. If you do that project, invariably you will understand how to compute the intrinsic value of the company, what is WACC, all that you'll be understanding in detail. Okay, that's how should be. That's how you should be learning. Because for one sample company, I've shown you how to do it, and you can do it for your own companies later on. Okay. So that's all from my
Right.
side, class. I wish you all the very best. Okay, we'll meet in the next session.
Thank you, sir.
Thank you, sir.
Thank you,
Thank you,
sir.
sir. Good night, sir.
Good night.
Yes, sir.